Welcome to P2 Corporate Reporting. In this section, we are going to look at reporting related party transactions in corporate reports. IAS 24 Related Party Disclosures is the standard that guides us. You have not seen this standard in F7, so I will go over it in this video. IAS 24 requires transactions and outstanding balances with an entity's related parties to be disclosed. A related party transaction is defined by the standard as a transfer of resources, services, or obligations between related parties, regardless of whether a price is charged. So, our starting point is what or who are related parties. A party is considered to be related to a company if it exerts control over a party or a party exerts control or influence over it. So, for example, a parent-subsidiary company situation. Or if it is under common control with an entity, so two subsidiaries in the same group. Or without control, has significant influence over the entity. So, for example, what about the CEO's wife? They are a related party to the company. Think about this above definition of related parties and companies you may have dealt with in the past. The definition is quite broad, especially when close family members are included. Why is this important in the presentation of financial statements? Think about this for a minute. Company X sells land, a company asset, for $100 to Miss Smith, who happens to be the daughter of Mr. Smith, the CEO of Company X. Now, if you heard that as a shareholder, what conclusions would you draw? Therefore, any related party transactions must be documented in the financial statements. When a related party transaction occurs, users of the financial statements will want to see that. And shareholders will want to see that the transaction occurred at arm's length. What does at arm's length mean? At arm's length means that the transactions are occurring under normal market conditions or values. So, back to the example with the CEO's daughter buying the company's land for $100. The land sold may not be worth much on the open market, for example, due to a massive chemical contamination. If this is the case and an independent valuation has valued the land at $100 or less, and the other parties could have purchased the land, then the transaction was at arm's length. What if the market value of the land was $1 million? Well, clearly the transaction was not at arm's length. When you look at situations, you have to assess if there is a related party element in the transactions. It is worth noting the following are not deemed as related parties unless, of course, they satisfy the criteria. These include providers of finance, so a bank, once it doesn't control or jointly control the company. Also, if two companies or more have a common director or key manager, the companies aren't necessarily related parties. If the company has a main customer whom they get most of their revenues from, this isn't necessarily a related party either. And finally, two venturers who share joint control over a joint venture. So if Company A and Company B control Company X jointly, A and B are not necessarily related parties. Okay, so now you have an idea of who a related party is, and you can identify them in an exam scenario. What next? Related party transactions are disclosed in the notes of the financial statements. The standard requires that relationships between parents and subsidiaries are disclosed regardless of whether there have been transactions between them. An entity must disclose the name of its parent and, if necessary, the ultimate controlling party. The total of key management's compensation must be disclosed, and it must be separated out under the following categories: short-term employee benefits, post-employment benefits and other long-term benefits, termination benefits, share-based payment benefits. Key management personnel are those with the authority and the responsibility for planning, directing and controlling the activities of the entity, directly or indirectly, including any directors, either executive or otherwise, of the entity. Given that the shareholders vote in the directors at the AGM, they are very interested in this information. These days, it is common to consult or contract key management services from a consultancy firm. In this situation, the amount paid to the individual employees of the consultancy firm is not disclosed. But the firm will have to disclose the amounts paid for these consultancy services. Related party transactions must also be disclosed. In this disclosure, the nature of the relationship and the details of the transactions and any outstanding balances. This gives the users an understanding of the impact of the relationship on the financial statements. A separate disclosure is needed for each category of related parties and needs to have the amount of the transactions, the amount of outstanding balances, the terms and conditions of the transaction, any guarantees provided, any provision for doubtful debts related to the outstanding balances, any expense recognised during the period in respect of bad or doubtful debts from related parties. As you can see, there is a lot of information that must be disclosed when a related party transaction has occurred. The balances outstanding are very important because although a transaction may have been undertaken at market values, if the balance is never paid or the party receives extended credit terms, the users of the financial statements will be interested to know. Now, what if the transactions did occur at arm's length? This can only be stated in the financial statement if the arm's length transaction terms can be substantiated. Go back to our example of the land for $100 to the CEO's daughter. The claim of the transaction being at arm's length would require citing the conditions that the valuation was reached, i.e. the independent valuation was carried out and that the property was sold on the open market, etc. As you can see, the burden is on the directors to demonstrate that the transactions were at arm's length. IAS 24 Related Party Disclosures is exactly what it's called. It's all about the disclosures in the financial statements. It is a standard that can be easily added into scenarios rather than an entire scenario focusing on the standard. That said, never say never, and if you practice a few questions, you'll be able to manage what the exam throws at you. Thank you.